Today, we have our good friends and partners at American Century hosting the call today to review their 10th annual Retirement Savers Survey. We have Glenn Dial leading the call today, who is American Century's Senior Retirement Strategist. So please give a warm welcome to Glenn.
Great. Thanks, Leah, and thanks for joining everybody. So we're going to spend the next 30 or 40 minutes or so going over our 10th annual survey. And what we do is we survey both plan sponsors and participants. We surveyed 500 plan sponsors and 1,500 participants. Of the participants, it was evenly divided between boomers, Gen X, and millennials. So with that said, as a background, let's go ahead and jump into some of the survey results and probably more importantly, how do we interpret these survey results to be useful in your practice and to differentiate you? And we'll try and give you some ideas there. So how do participants save them or grade themselves? And for the most part, not so well. So, if you look at the past 3 years, anywhere from a C plus to a B minus back to a C plus. So not great in terms of self grades. And that probably is true, right? In terms of we know we can do a better job as an industry in terms of saving. But in some respects, we've done a pretty good job. And we'll talk about that also. When we ask participants, hey, well, what concerns you, between housing and credit cards and market, and we added market volatility this past year. And of course, we came off of a year of market volatility, and that jumped to number one at 41% in terms of their retirement concerns, followed by housing expenses. Right? No shock there. I think I saw a report today. We're at a 39-year high in terms of cost of home ownership. So that's a real concern. Balancing work, right, and family has always been a concern. And then credit card jumped up this year also. So the two that kind of moved up the ranks, if you will, were housing expenses and credit card debt. And of course, we added market volatility to that. Employers, when we ask plan sponsors, hey, what concerns you about your employees? Number one on the list was market volatility for those closest to retirement. And sometimes we lose sight of that. We think about volatility and, well, it's no big deal. Time solves all problems and whatnot, but not so much if you happen to be retiring in a down market. Well, then that causes a whole host of problems for not only the employees, but for the plan sponsor. And right behind market volatility, what for those closest to retirement was employees won't be ready to retire. Right behind it. Now you might be thinking, well, wait a minute, don't we have a problem with most companies don't have enough employees, they need to hire more? Yes, but on both sides of the fence here, if the employee has reached retirement age and they're ready to retire, and more importantly, they want to retire, but they can't because either the markets have just went down or they didn't save enough, that creates problems for them, not only them, but for their employer, right? Then we get into this whole idea of presenteeism and productivity going down and insurance costs going up and all that fun stuff. So it creates a host of problems. Again, no, I don't think shouldn't be shocking, but again, these are real concerns from plan sponsors. I would suggest that this slide may be one of the most important slides of the day. 1/3 work with an advisor when we asked participants. Now, I think that's high. When I ask advisors how many employees you work with or participants you work with in a given 401k plan, some tell me it's only 5%. But regardless of what the percent is, whether it's 5% or 33% or something more, we do know there's a big segment of the population in 401k plans who do not have an advisor. And you might be thinking, well, so what? there's not enough advisors to go around, or they don't have a high enough account balance, or they don't want to engage, whatever it may be. But here's the flip side of it. And remember, when we say 401k plan or 403b or 457, we're calling these retirement plans. So if we think of this in terms of a traditional retirement plan, and both my parents were in a traditional retirement plan. And what that meant was if they did nothing, 0.0, they did nothing, they were going to be okay. Not only through the savings phase, right, but through the income phase, because employer did everything on your behalf, right? You didn't have to do anything. And you're okay. They're okay, right? They got their Social Security and their pension. They're happy. My question, this 44%, or maybe it's really 70%, or maybe it's 90%, if they do nothing and they don't have access to an advisor, are they going to be okay? So if they do nothing, are they going to be okay? I'm not so worried about this 33% that have an advisor, because they have someone guiding them through, especially as they get closer to retirement. They have someone helping them with an IRA rollover, right? And helping them put together an income strategy. But this group over here, what happens to them? Did they save enough? If they did save enough, do they know how to convert it to income? Or maybe they don't need income, maybe something else. So this is what I worry about the most. I think this is what the government worries about the most. And I think that's what we as an industry need to solve for, so that we can finally call a 401k plan a retirement plan. Because today I would just call it a fancy savings plan, not a retirement plan, at least for this percent of the population that are not being served by an advisor. So perceptions, when we ask employees, hey, do you want a kick in the pants or a nudge, and most, not surprisingly, most employees say, yeah, I either need a kick in the pants or a strong nudge or a slight nudge. Very few say actually leave me alone. And again, this goes back to the old days of DB plans. I mean, companies still have DB plans, but think about it. In a DB plan, you didn't have to do anything. It was done for you. So it's very important. We ask another question about auto enroll. Now, we used to always ask around 6%, and most employees said, yeah, definitely auto enroll me. About 70% every year would say auto enroll me. We took out 6% and put in 10%, just to see what they would say. And just as many, right, said that, yeah, 10%, or 71% said do it. But in this past year, we took out the other, right, the other, the 6% option. So that's a little deceiving, but net, we know that employees are okay with auto enroll. I would say that the most popular that I see today is auto enrolling at 6%, and then auto increasing at anywhere from 1% to 2%. Seems to be happening, no problem. No, people are not backing out of that at all. I think 10% is aspirational, and hopefully we'll get there. Okay, when we ask employees now, so switching back to employees or participants, hey, what concerns you the most? Should be no shocker here, but what used to not even register, or not register very high, inflation and interest rate risk, went all the way up to number one, right? 64%. And we finished the survey, by the way, in January of this year. So inflation had been kicking in a whopping 15% increase. Now, prior to this year, it was always the number one concern was either market risk or longevity risk. And in some years, they would switch back and forth, but it was always those two. You could always count on market and longevity risk, and which is interesting, right? Because this is the yin and the yang. Longevity risk says, oh, I need more growth, or I need some kind of guarantees. And market risk says, well, I'm afraid the market's going to crash, especially before or after I retire. So that was always 1 and 2. Now inflation is number 1, and that might be sticking around for a while. We don't know. When we ask plan sponsors, what do they think target date funds address? What risk do they think they address? And for the most part, they got it right. They said, hey, you know what? We think that it's extremely important for target date funds to address market risk and growth risk and longevity, inflation, and interest rate risk. You see inflation and interest rate jumped up there, number one also. But the good news is, if you look at just about any target date fund on the market, this is truly what they're trying to balance, right? They're all managing these risks. They just manage them in different ways and in different percentages. In other words, some target date funds might put a more emphasis on managing growth risk, meaning they take more, right, heavier weight in stocks. Others might take more emphasis on market risk, right? More conservative assets they might manage more. So it just depends on the target date vendor. But all of them are trying to keep these risk in balance, right? That's what they're supposed to be doing as a target date fund. When we ask participants, hey, do you want to take more or less risk? 50, it's kind of split. So 56% said today's markets are so volatile that people my age need to be more conservative with their money, right? 56%. But right behind 55%, and by the way, they could choose more than one answer. 55% said you must take significant risk in today's economy to seek significant gain. So it's kind of split between, hey, don't lose my money, to no, I want to take more risk. And that's, that I think that makes all of our jobs harder, right? And it makes our jobs harder, especially when we think about targeted funds and whatnot. So how do we get that mix correctly so we can take care of the entire population? Third question, what came in a close number 3 was, I would be interested in purchasing insurance to protect my income. And we're going to see this income thing keeps creeping up because, our industry is over 40 years old now, over 40 years old. So it's starting to mature, and the way we, again, address income is just through the IRA rollover market, which again is great if you have an advisor. But if you don't, then we need to start thinking about, well, how do we solve for the hardest part of the journey for participants who do not have an advisor? When we ask plan sponsors about targeted funds, what's most important, and this was a little surprising to me, they said active management was the most important attribute in a target date fund. Now, keep in mind that this plan sponsor survey was just getting finished up at the end of last year. So we came off that market dip last summer. And my best guess is a lot of plan sponsors, associate active management with some built-in risk management, right? So that jumped to number one terms of being extremely important, followed by lowest fees, collective trust, which is somewhat like lowest fees. So again, shouldn't be shocking. We typically see, kind of that herd mentality if we're in a bull market, it's all about lowest fees and highest performance. And if we have a little market hiccup, well, active management or risk management jumps up as most important to plan sponsors. I would say we're in a little bit of a back to chasing returns, and we'll talk more about that in just a couple of minutes. We ask plan sponsors, this is always, I've been doing, whether it's this survey or other surveys I've been part of, I've always seen this question come up, and here's kind of a dilemma, if you will, about this question. So plan sponsors were asked, would you rather, about target date funds. So would you rather have a target date fund that helps most participants protect their savings from significant losses, even if it means waiting out periods when it's underperforming peers or the market? 67% of plan sponsors said that's what they wanted. 32% said they wanted a target date fund with potential to outperform the market, even if it means waiting out periods of significant volatility and possibly large losses. So this is consistent, by the way, with just about every survey I've ever seen around target date funds. What's also interesting is when I look at real world behavior, it's kind of the opposite of this, right? You have about 67% of plan sponsors actually pick more aggressive target date funds, and then 32%, not exactly, but it's almost exactly, it's almost opposite of this in terms of their action versus what they say they want. And I think that's just a head scratcher. It's been that way ever since I can remember, in terms of surveys versus actual behavior. So let's just take a step back, go down memory lane for a little bit. And this is something that I lived, so I'll share with you what it was like back in 08, 09. So obviously it was the financial crisis. And it was the first time ever that both the DOL and SEC held a joint investigation on a 40 Act fund, right? And here's why. Because the 2010 target date funds, which are your 65-year-olds, when they looked at the difference in returns from peak to trough, 08 to 09, so your typical 65-year-old was either down almost 10% or down 42%. 10%, 42% negative. So the DOL and SEC, I mean, they got very, very concerned about the whole target date industry. Hence the joint hearings that were held. How could you have two target date funds that had the exact same thing, 2010, yet the returns be so different? I was speaking at not a conference, but an advisory council meeting for a large record keeper, and they had their top clients in. So most of the clients had about 30,000 employees, and there was about 15 of them. And when I asked them, and now these, in fairness, these were the heads of HR. So think of about 15 head of HR, typical company, 30,000 employees. When I asked them, what do you think the difference was in the 2010 target date funds during that, worst financial crisis we've seen in decades? Most of them guessed the difference in performance was between 1% and 2%. Between 1% and 2%. When I told them it was over 30%, their jaws hit the floor. I mean, they could not believe that was the difference. So we've already, for me, it doesn't seem that long ago, but hey, it's close to, I guess, about 15 years ago. And we've already kind of lost our memory about, how bad that event was. So here's how it played out. The SEC and DOL said, hey, we're going to make a new rule. And the new rule is going to be that you're going to have to put a risk moniker of some sort, net descriptor, next to the target date fund. So it'll say, XYZ 2010 target date fund. It'll either have to say aggressive, moderate, or conservative. Aggressive, moderate, conservative. I have to put that next to the name of the target date fund. Now, the industry threw a fit about that. They said, oh, no way, you can't, there's no way to even measure risk. You can't measure risk in target date funds, which I thought was laughable. And by the way, I did write a letter. The company I work for, we abstained, we dissented from the industry's position. We went and met with the DOL and SEC separately, told them, yes, you can measure risk. You should, we like what you're doing here. But net, time, I guess, heals all wounds, and they backed off the requirement to put some kind of descriptor next to the target date fund. And what we got instead was the DOL tips that was released in 2013. And the tips focused on target date suitability, which really means take the participant characteristics into account, document them, and align them with a target date fund that has similar characteristics. So all you're doing is aligning, right, the characteristics of the target date fund to that of the participants, and documenting it. That way, you're not comparing apples and oranges. There's over 40 target date funds or 50 target date fund families out there. So you don't want to compare apples and oranges. And unfortunately, as an industry, that's what we do today. I hear this all the time. Hey, how come your target date fund is in the bottom quartile or the top quartile of your peers? I'm like, well, what peers are you comparing us to? Are you comparing us to an entire universe? Because that's probably not our peers, right? So I notice that most folks aren't taking that extra step to actually develop, what I call a true peer ranking when we're doing reviews of target date funds. They're just throwing it in a basket, put them all together. That would be synonymous to taking every equity mutual fund, whether it's large cap, mid cap, small cap, growth or value or blend, right? Just think of the Morningstar 9 boxes, put them all in one category and rank them and say, hey, your large cap growth is underperforming small cap value. There's something wrong. Well, why are you comparing those two? I mean, that's right. That'd be a head scratcher, but that's what we do in target date world. We put them all together and pretend they're all the same. And that's just not right. It's just not, it's not true. They are very different. They have different goals. They have different characteristics. As an industry, some of us do take that extra step, by the way. And I know RPAG does a really good job in terms of looking at, right, the three different risk buckets and focusing on suitability and not chasing returns. I saw that at the Yale's National Conference. So it's great to see how your worldview is. I agree with it. I think you're leading the industry in terms of how you look at target date funds today. So I commend you on doing that. One of the biggest, when you think about optimizing a glide path and you look at the characteristics, savings rates is the number one impact of what that glide path should look like in terms of how much risk you should be taking. And if you take one thing, take this from this presentation, is the higher the savings rate, the less risk the target date fund should be taking. The higher the savings rate, the less risk the target date fund should be taking. So if you've done a good job, whether it's through education meetings or auto enroll and auto increase, and you've got those overall savings rates, which includes deferrals, match, and profit sharing. And by the way, you can't look at the 5,500 form to figure out the savings rates because they throw the zeros in there. You got to take the zeros out. We can't build a product for people who aren't participating. They got to be in the plan, right? And let's just say you got those savings rates up from 4% all in to 8 or 9% all in. Well, those are two different types of target date funds that are a good fit for that employee population. So have you went back and reviewed, right, the target date fund to see if it's still a good fit or not? And again, savings rates, everything else being equal, is one of the biggest factors when we talk about optimizing a glide path. So I just cannot emphasize enough how important knowing what that savings rate is and what the impact is on the optimization of the glide path. Which brings me to my next point, which is, are we, I said should here, but should target characteristics look more like a DB plan? And by the way, that's how most target managers optimize a target fund, is they think in the same way a DB plan would be, meaning that if the way a DB plan works is the closer you are to being fully funded status, right, the less risk the manager needs to take. That's why on the savings rate, right, the higher the savings rate, the less risk you need to take. So so when you think about target date funds, we have to put a different hat on. We have to think more like a defined benefit plan, right? And what are some of the good points about that? Well, if we're not taking unnecessary risk, well, it means participants have less stress, right? They're not stressing as much during the down markets, all right? And we know what financial stress does to employees' productivity and health and all that fun stuff. Also, and this is very important, also, if we have high savings rates and we don't need to take as much risk, it means more people can get across the finish line, right? You want less variability. And right, introduce the concept of guaranteed income. Should we have guaranteed income associated with target date funds? That's a good kind of segue into our last part of the survey, which does deal with income. So not surprisingly, right, most employees say, yeah, or most participants, say, yeah, I need help drawing down money from my retirement account. No surprise there. I mean, think about what we've done as an industry. We've done some really, really good things in terms of getting employees to save money, to save more, to invest the right way, all through auto features or education. But we've done a pretty good job. I was looking at a survey from Fidelity's record-keeping system the other day, If we go back to '05, the average savings rate of those that were saving, right, and including employee match and profit sharing, was less than 7%, like 6 point something. A few years later, it went up to like 8%, and now as of last quarter, it's over 13%. Over 13%. So we've done a really good job as an industry getting those savings rates up. But now we get to the hardest part of the journey, arguably 5 to 10 times harder, which is how do you convert these savings to income? And for all that, let's call that 70% who don't have an advisor to help them through the IRA rollover process, we literally kick them to the curb and say, "Good luck. Hope you figure it out." Maybe you have a friend or family member that's going to give you some advice. Maybe you do. Find an advisor, maybe not. Maybe you do what other employees are doing. And oh, by the way, if once you retire, if you get it wrong coming out of the gate, you might not be able to undo it. So getting this part right, the hardest part, is really, really important. And you don't really get a do-over here. So, we really need to kind of take this to the next level as an industry, right? To help these folks and help employees. And nearly all plan sponsors agree, right, that they should offer some kind of income feature. And what's interesting here, every time we do a survey, we ask participants and plan sponsors, "Hey, do you want income? Do you need it?" And most of them always come back and say, "Yes, we do." When I talk to advisors, they all tell me, "No, our plan sponsors don't ask for it at all." So there's a disconnect depending who we ask. Either it's no, there is no need, or no, there's tremendous need. So I think that's starting to change, by the way. So we're starting to see more and more push from plan sponsors reaching out to folks like yourself. Another shift that we saw in the survey is that 4 and 5 plan sponsors prefer to keep the assets in the plan. A few years ago, this was about even, and before that, it was the opposite. So what changed? Why all of a sudden do plan sponsors want to keep assets in the plan? I think it's 2 reasons, really. Number one, right, especially I guess with all this fee litigation going on, they realize the more assets they have, the more buying power they have, and the more negotiation power they have. I'm sure that's part of it. And the other part is they just want to do the right thing, meaning that especially as you get close to retirement, especially if we're looking at guaranteed options, do you think about this? Think about yourselves. When you get ready to retire, do you want an institutionally pre-screened, institutionally priced option that gives you guaranteed income? Or do you want to buy a retail option that may or may not be good, again, depending who the advisor is, and it's probably going to be 2 to 3 times more expensive? Well, it'd be nice to have some institutional options out there for the masses. Again, I'm not trying to say that it's going to be a fit for everybody, because I think your higher net worth, higher account balances are going to be, could arguably be better suited, roll the money over, getting more customized solution. But for the masses, to have something institutionally screened and priced is probably a good deal. About 31% have realistic expectations on what they're going to generate in income, which is about 5%. Some said they didn't know. Some said less than 5%. So it might not seem realistic, like a high number, but it's better than it used to be. It used to, everybody thought they were going to get 10%. Couple of questions on this one. I think they're both important. The one on the left that says, we asked them how important it is to protect your entire workplace savings in the event of some kind of stock market crash. Now, not surprisingly, just about everybody said, "Oh yeah, that's very important to protect my entire account," right? Not just part of it, my entire account. And that's kind of like if there's stock market's going to crash, I don't want just like 20 or 30% of my account protected. I want it all protected. And then when we ask the next question, so, well, at what age should you start this protection? Because keep in mind, if you go into some kind of insurance product, they cost more money. So at what age does it make sense to start paying these extra fees to get this to protect your income? And starting at about age 50 was the earliest. 3 and 10 said age 50, and then more said 55 and 60. But just about everybody said it needs to happen at 60 or be before 60. So, which makes sense, right? Because almost half. This is a big stat that most people don't know. It came from Ebury. Almost half of employees retire earlier than they expect. I think it's like 48, 49% retire earlier than expected. And it's not because they saved a bunch of money and they can afford to retire early. Mainly it's because they have healthcare concerns for themselves, their loved ones, or they're laid off, right? So that's why they want this protect. I think most employees say, yeah, I might not make it to my expected retirement date. Let's get that protection started early. Or what if the stock market is 30% lower when I retire? I want that protection in place so I can retire on time. However, there is a caveat. About 3/4 want 100% account control and flexibility, meaning that they don't want to give their money to an insurance company with a promise of income. They want to keep control of the assets, right? They want 100% control. They want the assets to be there just like they are now in their 401k plan. If they start taking income, they change their mind. They want their money back and they want to enjoy any market growth that occurred along the way. So they want their cake and eat it too, right? So they want the best of both worlds. So, and we're seeing products now that do that, right? So, and I would argue in some ways they're better than a traditional DB plan, because a lot of your traditional DB plans, especially the early days, did not give you the option to take your money and let's say 2 years into it, you find out you have terminal cancer, right? And you're going to die in 6 months. Guaranteed lifetime income is probably not that great of a deal. You probably want your money to either have it to leave to your heirs, or maybe you're going to go and blow it all and have a good time. But regardless of why, we know that participants want, right, that control and flexibility of all their money. So then we ask the next question, which is, and by the way, one more point about this control. We asked a follow-up question. We said, hey, which would you rather have? 5% guaranteed income, but 100% control? Or what if we up your income to 6% and you have to give up just a little bit of control? And that's how we worded it. Give up a little bit of control. 2-to-1 said, give me 5% and leave me 100% control. So again, it is a big deal. When we asked them, well, how much of your account should be guaranteed, right? Should your entire account be guaranteed, or some percent of it? About 70% said, protect the whole doggone thing. I'll figure it out when I retire if I'm going to take income on everything or not. The other 30% said, no, I need a specific percent guaranteed. And it just our question just happened to read 30%. So don't get those two. They just happen to be the same number by coincidence. But net, what does that tell us? It tells me that this 30% here, employees probably these are probably the ones that have an advisor. They know they probably already got some kind of advice that they don't need, right, their entire account protected. This 68% here, almost 70%, are probably the employees that don't have an advisor. And so they just want the whole doggone thing protected. They want to be defaulted into it, and they'll figure it out when they get to retirement type thing. So, what we're seeing here is kind of two different, right, cohorts that we're trying to serve. So when we kind of take a step back, think about what we went through, and it really is kind of a story that we weaved through, which is, we know defaults are good, right? It's helped us get to where we are now as an industry which I think are some really good savings rates overall. I mean, I think we're kind of critical of ourselves and say, well, we're not doing good enough, but we've done pretty doggone good. And these auto features and auto defaults have helped quite a bit, right? And participants, right, they do look to their employers and advisors, right, to help with these automated features. We know that volatility, right, is a big need. We also know, or not big need, a big worry. But we also, what I'm hearing a lot now, especially when it comes to target date funds, is we're back to chasing returns. All plan sponsors care about are fees and returns, and they're not looking at suitability, which is a head scratcher. When I look back at '08 again, now the only good news in '08 is we had less than $200 billion in target date funds going into '08, less than 200 billion. Now we have over 2 trillion. So if we have a same event as '08 that happens today, and we have the returns of, let's call it a 2025 fund that are 30% different, that's not going to be a fee lawsuit that's based on 10 basis points difference in fees when you're talking 3,000 basis points, right, in the same fund that has the same name. That's a different kind of lawsuit. So I think we have to be prepared and get in front of this from a suitability standpoint. And then, of course, the last piece to the puzzle is this whole decumulation part, right? And the way we've solved it is through IRA rollovers, which is fine. But let me give you a quick story. This is a true account. When I was at a different firm with a different client, and I took this client out, and I'll use their name because they gave me permission. It was Philips International. They're based in the Netherlands. The law in the Netherlands at the time, through '08, '06, '08, was if you were in a DC plan, you had to buy an immediate annuity within 30 days of retiring. You had to buy an immediate annuity within 30 days of retiring. So what happened? There was 2 employees. They were engineers. They were friends. And they had about the same earnings, same account values going into '06. One decided to retire in '06, bought his immediate annuity 30 days later. His buddy retired 2 years later. End of '08, his account balance was down 30%. He bought the annuity within 30 days like he was required, and he got guaranteed income for the rest of his life that was 30% less than his buddies because the market value was down 30%. I mean, they came to us and said, hey, that's just not fair. You can't have 2 people. They essentially did everything right going up to retirement, but one was lucky and one was not lucky just because that's where the stock market was. So that is where we are for the most part as an industry when it comes to 401k plans. So we have to take the luck out of it, right? And give everybody that if they saved enough money and they did everything right, to not leave it up to luck if they're going to have adequate income or not.